Okay, so let's just make sure that everyone is on the same page of before the adjustment happens, what the balances are. Okay, so for account receivable, we have a balance of 34,000. It's going to be a debit balance. This is not explicitly stated, but we know assets are debit normal. So this is our beginning balance. And then allowance for bad debt has a credit balance of 3,000. So these are our beginning balances. Now let's do our journal entries. So we have sales of 189,000. So we're gonna have sales revenue. Okay, and that's split between 165,000 in on credit for accounts receivable and 24,000 for cash. So we'll have cash, accounts receivable. We're not really doing the cash T account. We're just really, this exercise is for receivables, so we won't worry about that. But we do have this debit of 165,000 from the period. Okay, so this first one is done. Collections on account, 133,000. So what that means is that of this total, right now we have 199,000. 133,000 of that got collected. Those customers paid us. So we're receiving cash and we're reducing accounts receivable. Okay, so I put this. And so now my balance, this is my unadjusted balance. Because remember, we're going to do an adjusting entry for allowance for bad debt. But right now, our unadjusted balance at the end of the month is 66,000. Okay. Okay, so then we did this one. So the last one, C, write-offs of uncollectible receivables. Actually, sorry, I'm wrong. We still have to do this. This is not complete. So write-off of uncollectible receivables, 2,800. So what that means is that we've determined that some of our account receivables are uncollectible. So we're going to write those off. We're going to reduce account receivable by 2,800. But we're also going to draw on this piggy bank. We have this $3,000 set up to kind of account for that. We expected this to happen essentially. So we already have that allowance for bad debt piggy bank that we're going to debit. Okay, so now we'll have our unadjusted balances. And then this is going to be a credit balance, 200. No? Okay, so I will pause it here. Now, what we are saying is that this allowance for bad debt, the unadjusted, we need we need to change this because now we have in number 3, we want to have this allowance for bad debt be a new balance based on our ending balance of account receivable, which we also have here. Okay, so we're going to use this 63,200 with the information in number 3 to figure out what this should be. Okay, so that's going to be X. So once we have X, we can figure out what our adjustment has to be. We had on the quiz, we had this where we know what the balance is going to be in the T account, but we need to then figure out what needs to be debited or credited to get to that. So you're going to kind of use what you did on the quiz to finish this. Okay, so take a couple of minutes, see if you can just finish that up. Okay, so what this is saying is that uh, we're assuming that the bad debts are going to be 2% of the accounts receivable. That means that whatever balance we have at the end of January, we're expecting that we're going to collect only 98% of it, and 2% of it is going to be written off. Okay, so what is the balance? 63,200, and what is 2% of that? Let's see. This times 0.02, 1,264. Okay, so that's That's going to be our target balance here. Okay, so this should be our ending balance. This should be our adjusted balance. And we have an existing, and we know allowance for bad debt is a contra asset account. It's got to be a credit balance. We have an existing credit balance of 200. So to get our adjustment, we just take our target balance minus our existing credit balance, and we get 1,064. So that's how much more we need to add to allowance for bad debt to get to this target. Okay, so we would just do 1,064, 1,064. We're going to take this. The whole point of it is to record an expense called bad debt expense. And we're going to add that kind of like a loss you can take to this piggy bank called allowance for bad debt. And then, so when we report what our balance sheet accounts receivable is, it's going to be accounts receivable net. It's going to be equal to this minus our new balance. That's how much we were going to report our balance sheet. Now, let me do a little trick, okay? Let's say that instead of 2,800, this was like, I don't know, 4,000. Okay, let's just change this to 4,000. So we change this to 4,000, change this to 4,000. Okay, so now we have a debit balance here. Okay, and we have a different balance for account receivable. Think about now what the adjustment would be. What is the adjusting entry now? Take a minute, see if you can calculate that. Okay, so it's the same math. It's still 2%. So we do this times 0.02. Okay, so now we know that our allowance for bad debt, it's got to have a credit balance of 1,240. We have an existing debit balance of 1,000. So how do we get from a debit balance of 1,000 to a credit balance of 1,240? What do we need to do? The allowance for bad debt. Exactly. Okay. We need an adjusting entry of 2,240. Okay. So let's just we'll change this to 2,240. Okay. So when you do this, again, if this is our existing balance, we then have this credit 2,240. Our new balance is this minus this, which is what we wanted. Okay, so we had to take a much bigger expense here. This is going to reduce our net income. And the reason why is because we messed up in the previous period. We didn't have enough in our piggy bank, so now we're paying for it in the next period. So this is why even with the allowance method, it's not perfect. You're not going to have an exact matchup between the expenses for bad debt and the revenue, right? Because if you under reserve in previous periods, you're gonna pay for it later. Okay, so you're still kind of violating the matching principle, but at least you tried. And again, if you're like an honest and like fair-minded business, you're gonna try to do a good job and not really have this happen regularly, where you under reserve and then you have to take a much bigger expense later.